Welcome to The Explainer. Today, we're diving into a report that shows Asia's economic engine, the one that powers so much of the world, is starting to sputter. We're going to look at why a really sunny forecast suddenly turned cloudy and what that could mean for all of us. So, 2025 kicked off on a real high note. Growth across developing Asia was picking up speed, thanks to people buying more stuff at home and a huge, powerful surge in exports. For a minute there, it really looked like the region was just firing on all cylinders. But, that good feeling didn't last. As we're about to see, the very thing that gave the economy that early boost was also a warning sign. A sign that the economic weather was about to change, and change fast. Okay, so here's where the story takes a turn. Back in April, the Asian Development Bank was forecasting 4.9% growth for the year. By July, just a few months later, that number was cut down to 4.7%. Now, that might not sound like a lot, but that little drop, it represents billions of dollars in lost economic activity. So what on earth happened in those few months? Well, that brings us right to our first section. We're going to break down exactly why this outlook got worse and figure out what's causing this massive economic engine to sputter. So this is the new headline number. 4.7%. The report is pretty blunt, saying the downgrade is because of an increasingly challenging external environment. But what does that jargon actually mean? Let's get into it. The report points its finger at one main culprit: a global trade storm. It's all fueled by rising tariffs and a whole lot of uncertainty. And this storm is what created that kind of fake, rosy picture at the start of the year. To really get what happened, we need to talk about this term, export front-loading. It's actually pretty simple. When companies hear that new tariffs are coming, they basically scramble to ship as many of their goods as possible before those new taxes kick in. This creates a spike in exports that's totally artificial and, you guessed it, temporary. And this process happened in 4 clear stages. First, the U.S. announced future tariffs were on the way. That set off an export rush, with Asian companies trying to beat the clock. The result? A short-term boost that juiced the growth numbers in the first quarter. But now we're in the final stage, the hangover. That surge is gone, and it's revealing that the momentum underneath was a lot weaker than it looked. Of course, Asia is a massive, incredibly diverse place. This slowdown isn't hitting everyone the same way. Not even close. So let's do a quick tour around the continent and see how different areas are holding up. You can really see the impact of all this trade uncertainty here. I mean, look, the big hubs in East and South Asia saw their forecasts trimmed just a little bit. But Southeast Asia, it got hit hardest. Its growth forecast got slashed by 0.5 percentage point. That's a direct result of weak external conditions just hammering business and consumer confidence. But okay, amidst all this gloom, there is one bright spot. The Caucasus and Central Asia region actually saw its growth forecast revised up. Why? Well, it's mostly thanks to Kazakhstan, where things are stronger than expected, supported by really robust oil production from a major expansion project. Okay, so we've got a handle on the current slowdown, but what's coming next? The report lays out several major risks, economic wildcards that could make this downturn a whole lot worse. And the biggest what if of them all is about global trade. The situation we're in now is already tough. But what happens if the tensions, the tariffs, what if they escalate even more? The report actually ran the numbers on this. And wow, they are stark. A scenario where everyone starts slapping tariffs on everyone else, that could knock a 0.5 point off the region's growth. But an even worse scenario, a full-blown re-escalation of the US PRC trade conflict, that could obliterate growth by a massive 1.4 percentage points. The stakes here are just incredibly high. And it's not just about trade. There are other risks looming out there. New conflicts could mess up supply chains and cause oil prices to spike. A sharp downturn in the PRC's property market would send shockwaves everywhere. And even small policy changes, like a new U.S. tax on money sent home by workers, could really hurt smaller economies in the Pacific that depend on it. So we've got all this data on slowdowns and risks, but what's the big picture story here? Let's zoom out, because the report flags something that could be a really profound shift in the entire global financial system. I mean, listen to this quote. This is a pretty remarkable thing to find in a report like this. For decades, the US dollar and US government debt have been seen as the ultimate safe place to park your money during a global storm. And now this report is suggesting that this long-held idea might be starting to crack. And that leads us to a really fascinating and critical question for the whole world. Is the very foundation of the global financial safety net changing right before our eyes? The evidence for this is really compelling. Historically, anytime there was a global crisis, investors would make a flight to quality, meaning they'd all pile into US assets. But the report says that during all this recent trade uncertainty, that impulse, that instinct, has gotten a lot weaker. Investors just aren't reacting as positively anymore. And that suggests this might not be just a short-term thing, but an early signal of a major, long-term rewiring of global finance. So we've gone from a simple story about growth numbers to a really fundamental question about the future. If the traditional anchors of the global economy, like the US dollar being a safe haven, are now in doubt, it leaves us with one final big thought to chew on. As these old certainties fade away, where is the world going to find its new anchors of stability?